The retirees who actually keep their money, the ones still comfortable at 78, at 82, at 87, writing checks without flinching, while their friends are quietly starting to panic, they didn't get there because they picked the right stocks or stumbled onto some secret tax strategy. Most of them did something that sounds almost too simple, something most financial planners never put in the brochure, something that when I first noticed the pattern struck me as genuinely weird. They sold stuff, specific stuff, and not the obvious stuff. Some of it is sitting in your driveway right now. Some of it is quietly costing you $180 a month and you've stopped thinking about it. And one of them is going to be harder to hear than the rest. A couple of these might sting a little because you're looking at one of them right now and you've been telling yourself it's fine. Stick around till the end because number one is the one almost nobody talks about, and it might be the single most important financial move you make before you retire. Let's get into it. Number 5. The vehicles you're not actually using. Now look, I want to be precise here. I'm not saying sell your car. I'm saying sell the other one. The boat that went out maybe twice last summer. The RV that hasn't moved since your youngest's graduation 4 years ago. The motorcycle that roared back to life for one glorious weekend in April and has lived under a tarp ever since. Here's what that stuff is actually costing you. Let's use the RV as an example. Average purchase price around $65,000. Current value maybe $38,000 and still falling. That's $27,000 in depreciation already gone, whether you touched it or not. But you're also paying, let me get specific, roughly $2,400 a year for storage, $1,800 a year in insurance plus registration and maintenance. That's over $4,200 a year for something you use for maybe 8 days. That's $525 per day of use. For an RV, I'll wait. And the boat. Look, I'm not going to be the first person to say this to you, but the 2 happiest days of a boat owner's life are the day they buy it and the day they sell it. This is a universal truth, like gravity, and the existence of one mysterious charge on your cable bill that nobody can ever explain. Sell the extra vehicle before you retire. You get the money once, and then every single year after that, you keep getting the money because you're no longer paying $4,200 a year to park something that's already losing value in a storage lot. Number 4. Whatever is living in your storage unit. The average American pays $180.73 a month for a storage unit. That is $2,168.76 a year. That is $21,687.60 over 10 years. And most of the time, the stuff inside is worth less than that. I want you to go in there this weekend. Bring a flashlight. Bring a little courage. Look at what you're actually paying to keep. Furniture from the house before this one. Kids' stuff your kids have told you 3 separate times they don't want. Exercise equipment from a phase that ended sometime around 2007. A Nordic track that has been a very expensive coat rack since the 2nd month you owned it. I knew a retired school librarian who had been paying for her storage unit for 11 years. She went through it the summer before she retired. 3 weekends. Facebook Marketplace, eBay, a Saturday garage sale with her neighbor. She walked away with $8,400 in cash she didn't know she had. She used to say, "That unit was a museum to decisions I made in my 40s. It was time to close the exhibit." Meanwhile, I've spoken with couples who kept paying that $180 a month for 15 years in retirement because going through it always felt overwhelming, and then donated everything in the end. Donated it. After paying $32,526 to store it. Tell me again who was actually winning. Close the storage. Donate what doesn't sell. Cancel that monthly charge before you retire. Number 3. The timeshare. Buckle up. If you own a timeshare, you already know exactly where this is going And you're either nodding vigorously or you've already clicked away. If you're still here, I respect that about you. The average timeshare maintenance fee in America right now is $1,180 per year. That's just the fee for the privilege of owning the right to book a week in a property you're competing for with 51 other owners. And those maintenance fees increase roughly 4% per year. Compounding. Let me show you what that actually means. If you enter retirement at 65 with a timeshare and live to 90, which more and more people are doing, you will pay somewhere between $48,000 and $73,000 in maintenance fees alone. On a property whose resale value on the open market is, and I'm being generous here, approximately zero. And if you try to get out, there are entire companies, I'm not going to name them, but it's a whole industry charging people $3,000 to $10,000 to help you exit a timeshare you no longer want. You are paying to escape the thing you're already paying for. That's not a vacation plan. That's a financial obligation with extra steps. Get out before you retire. Talk to a legitimate exit company, not one whose website looks like it was designed last Wednesday, but make this a priority. The math on staying is too ugly to ignore. Number 2, your concentrated employer. Stock. All right, I want to give you a heads up first. This one might ruffle some feathers. There's a specific look people get when you suggest selling their employer stock. It's the same face you'd make if someone proposed repainting your childhood bedroom bright orange. Nothing about the reaction is logical. And yet here we are. If you spent 25 or 30 years at one company, and a lot of you watching did, there's a real chance you've built up a significant position in that company's stock. 401k matches in company shares. Options that vested. RSUs. An employee stock purchase plan, you maxed out because the discount felt like free money. And selling it feels wrong, I get it. You helped build that company. You gave it decades. Selling feels like disloyalty somehow. Here's the thing, though, the company does not feel the same way about you. That's not bitter. That's just true. The risk you're carrying is called concentration risk. If 20, 30, or 40% of your retirement savings is sitting in one stock, one company, you are one bad earnings report, one scandal, one industry disruption away from watching a significant chunk of your retirement simply disappear. Enron employees had an average of 62% of their 401k in company stock. Lehman Brothers employees, same story. These were not uninformed people. These were people who trusted the institution they spent their careers building, and that trust cost some of them everything they had saved. Diversification is not disloyalty. It's respect for your own future. Talk to a fiduciary, someone legally required to act in your interest, about how to unwind a concentrated position in a tax-efficient way before you retire. There are strategies laddering sales across tax years, charitable gifting, Roth conversions. But do it before you stop working while you still have the most flexibility. This is where a lot of retirements quietly go sideways. Not with a crash, just with one stock that stops going up. Number 1, the family home. This is the biggest one. The one that quietly derails more retirements than bad investments and unnecessary spending combined. And it's the one almost nobody talks about directly because it doesn't feel like a financial decision. It feels personal. I want you to picture 3 scenarios. You're a little bored on a rainy Tuesday in October, rattling around a 3,200 square foot house with 4 bedrooms and 2 people in it. You're not going to sell, you tell yourself you might need those rooms someday. So you just keep paying for the space. You're a little lonely because the kids haven't made it back since Easter, and the house is quieter than you remember it. Selling feels like admitting that chapter is over, and you're not ready for that. Your neighbors just redid their entire kitchen quartz countertops, one of those farmhouse sinks that costs more than most used cars. And even though you know you're supposed to be thinking about downsizing, something about keeping up still pulls at you. Those three forces, the boredom, the grief, the comparison, keep people in houses they've outgrown, paying for square footage they don't use for years longer than makes any financial sense. Here's what I call the equity trap. A couple with a home worth $760,000 paid off, free and clear, who downsizes to a $330,000 condo before retirement, walks away with around $390,000 in freed equity after costs. At a conservative 4% withdrawal rate, that's $15,600 per year in additional income. Every year, for the rest of their lives. And they stop paying $9,000 to $14,000 per year in property taxes, maintenance insurance, and utilities on a house that was too large for two people anyway. We're talking $24,000 to $30,000 per year that was sitting in walls and square footage nobody was using. The most powerful question I've seen financially comfortable retirees ask themselves about the family home is this one. If I didn't already own this house, would I buy it today? Not with the memories in it, not with the sentimental weight. Just would this house at this cost make sense for my life right now? For most people at 62 or 65, the honest answer is no. The memories aren't in the walls. They're in you. You don't need 3,200 square feet to hold on to the Thanksgiving. Your daughter turned 17, or the summer your son finally learned to parallel park without hitting anything. The biggest threat to your retirement isn't a bear market, isn't inflation, isn't even the healthcare costs that keep everyone up at night as real as those are. Sometimes it's this you on a Sunday morning walking through a house that's too big and too quiet that costs $22,000 a year to hold on to telling yourself you could never leave. Not because you can't. Because leaving would mean accepting that the chapter where the kids came running down those stairs on Christmas morning, that chapter is finished. It is finished. And that's not a failure. That's a life well lived. But clinging to the square footage doesn't bring that chapter back. It just costs you $22,000 a year while you wait for something that's already happened. Selling is not giving up the past. It's choosing your future. So there you have it. The people who actually retire comfortably and stay that way didn't get there because they were lucky or made some brilliant investment call in 1987. Most of them quietly sold the extra vehicle nobody was using, cleared out the storage unit that had become a museum to their 40s, got out of the timeshare before the maintenance fees had 15 more years to compound, unwound the employer stock before the market could do it for them. And they made the hard call on the house, the right-sized house where the equity actually worked in their favor instead of sitting there looking impressive. Was any of it easy? No. But you know what's even harder? Running out of money at 81 while paying $180.73 a month to store a Nordic Track from 2007. If this video gave you something to chew on, hit that like button. And if you want more videos on what people who actually retire well actually did not, the glossy highlight reel of the real stuff, go ahead and subscribe. Drop a comment below and tell me which of these 5 is the one you're sitting on right now. Be honest. I'm guilty of at least 2 of them myself, so this is a no judgment zone. I'll catch you in the next one. Take care of yourselves, and maybe this weekend go find out what's actually in that storage unit. You might have more money in there than you think.